Welcome to The Real in Real Estate, your gateway to the source. I'm so glad you're here. We're all about diving into the nitty-gritty of real estate, sharing insights, tips, and some awesome interviews straight from the industry's beating heart. From the latest trends to cool investment strategies, we've got you covered. Let's explore and uncover all the essential tools and knowledge you need for navigating the ever-evolving world of property and housing. Here we go. Good morning, everyone. Welcome to The Real in Real Estate. This is our first podcast, and I'm very fortunate to have my first guest as one of the premier lenders in Houston, Texas, and that is Chad Helcamp with BWC Lending. Hi, Chad.
Hey, thank you so much, Jean. I'm thrilled to be here. Thank you for asking me to be a part of it.
Oh, I'm excited you could do this. I just want to give everyone a little bit of information about you, if you can bear with me for a moment. Team fondly refers to him as the encyclopedia of loan knowledge, and I can testify to that because whenever I have a question, I call Chad. His commitment to finding the right loan for each person, no matter their background or situation, is not just professional excellence, but a testament to his genuine care and expertise. And I wanted everyone to know that because he's done all kinds of loans for me, including VA loans for friends and family. And when other people couldn't answer my questions, he always had an answer. So thank you, Chad, for joining us.
Well, thank you. Thank you very much. That is a very generous and kind introduction. I appreciate it.
I wanted to give, just since this is our first production here, I wanted to give everyone just a little background as to why I decided to do a podcast. And that's because when I first started in real estate, which was almost 16 years ago, I remember sitting down at my desk after I'd gotten my license and thinking, what do I do now? So my thought was go to the experts, which is exactly what I did. No one person can be an expert in everything. So I called on the experts. I called on the top producers, the lenders, the title companies to get the word out that was true and honest. No hearsay stuff. No, well, we did this 10 years ago. We don't do it now. So I went straight to the source. And that's what I'm bringing to you guys, straight to the source from the horse's mouth, so to speak. And today we're going to talk about lending, which seems to be everybody's topic of discussion at the moment because of the interest rates. I'm sure you get lots of questions every day. Is that right, Chad?
Absolutely. Absolutely. The questions never end. And I always tell people, I had somebody apologizing for how many questions they were. It's first-time home buyer apologizing for asking all these questions. I said, please don't apologize. I'd much rather you ask than not. And, I don't think there are dumb questions in our business. Maybe there are some, but very few.
Well, as a realtor, people obviously are asking me all kinds of questions about loans, and I send them to the expert. I mean, I know some things because I've been in the business a long time, but I want to make sure they get the up-to-date current information. So the topic that is on everybody's mind right now is interest rates. So what is the current interest rate? I know it's been holding around 6.6 lately. Am I correct?
Yeah, it's a great question, and obviously the one we get asked all the time. And I always tell people, I said, look, it depends, right? What rate you may get may depend upon where things stand. But at the end of last year, in the fourth quarter, we saw rates really improve quite a bit. And so in October of last year, September, October last year, they sort of flirted with 8%, which was a 40-year high. And so it freaked a lot of people out, stressed a lot of people out. And then we saw rates really start to improve because the inflation numbers continued to improve over the last quarter. The expectation was that the Fed was going to start cutting rates this year. And so the market just went crazy. And then we moved down into the low to mid sixes. And then in some instances, even the high fives for some clients. However, I think our market always tends to overreact. And I think that's what happened at the end of last year. And we're sort of seeing that now. Rates are kind of trending up a little bit. We ended the year kind of in the mid sixes, average rate of, like you said, 6.6. Fannie Mae and Freddie Mac have come out with their projections for 2024. They expect interest rates to average between 6.6 and 6.8, somewhere in that ballpark. And so I just quoted some options for a client this morning, great credit. His rates were ranging from around 6.375 to 6.875, depending on how he wanted to price his loan. So I think we are averaging right around that 6.6 to 6.5, 6.6% range as of today.
Well, I was going to ask another question, but while you brought that up, tell us some of the things that go into why I would have a certain percentage for my loan and someone else might have a different percentage for their loan. And I know it's a lot of different things that go into it, but in general.
I would say the biggest prediction of what kind of interest rate you're going to get is going to be your credit score. Okay. Several years ago, Fannie Mae and Freddie Mac had it priced such that I'll call it the FHFA. They're the ones who kind of control Fannie Mae and Freddie Mac. And if you had a 740 or better credit score, you qualify for the best rates available in the marketplace. Well, they tightened that up in the last year or so to where now it has to be a 780. And so if you have a 780 or better credit score, you should qualify for the best rates that are available.
Okay.
Every 20 points your credit score drops below that, you're going to see adjustments to your pricing. Those adjustments don't tend to be real significant until you drop below 720. And that's when you really start to feel it. Okay. So if you've got a 720 plus credit score, you're still going to qualify for really great things. In addition to the credit score, the type of property you're buying makes a difference. So whether it's a single family home or a condo, the size of the home, the size of the loan that you're taking out matters. So we have some clients that want to come in and, put, 70, 80% down, and then their loan's real small. And then that causes the rate to go back up. So loan size matters, the size of your down payment, your loan to value, the property type, credit score. So lots of different variables that come into play. And that's why I always tell people, let's have a conversation. Let me get the basics about what your goals and objectives are, and then we can start working that out. Then, like some people say, oh, well, I just got a rate of 5.875. And I hear that a lot. So, well, do you have the estimate? Send it over to me. Let me look at it. And invariably, whoever they're talking to, there's an online lender that everybody knows, probably the largest lender in the country. When I get their estimates, it's not uncommon to see 2 or 3 discount points on the estimate, which is a lot of money to pay up front to secure a lower rate. And so, yes, the rate looks great, but you're paying a fortune for it. And so I would say more people are paying discount points now than we've seen in a very long time. Probably 70 or 80% of clients we work with pay some discount points. But usually if you're paying more than 1 point, the break even on that is going to be 5-6 years down the road. And if you think that we're going to refinance in the next couple of years, you're probably spending money that you shouldn't.
Okay, that makes perfect sense. Let me ask you another question. A lot of people will say, well, my credit's not great. I really don't think it's time to talk to a lender. And I always try to convince them to talk to a lender, because who better to help them get on the right track than you? And is that a fair statement?
100%. And there is no doubt, I would say the largest objection that we deal with on a probably daily basis. I have this conversation 2 or 3 times a day sometimes. And it's one of those ones I wish I just could record it, hit play, and let them listen to it. But it's, oh, I don't want you to check my credit. It's going to hurt my credit score. And I would say probably better than 70% of the time, the people who follow our process, meaning they get pre-approved anywhere from 6 to 12 months prior to buying, the next time we have to pull their credit is better than it was the first time. And it's because we do a credit consultation, and I'd say the feedback we get the most, and anytime we're working with buyers, is what we hear the most is no other lender does this. And that's because we meet with every single client on Zoom, just like we are right now. I share my screen, I review their application, I review their credit report, and we go through it. And I always tell people there's 2 outcomes as a result of us pulling your credit. One, we find out that you're good to go. That's a pretty nice feeling to have.
Yeah.
And all you've got to do is just wait until the right house comes along. So that's one outcome. The other outcome is we have a problem. And guess what? If you've already found your house you like, we don't have time to fix it.
Yeah.
Whereas if you do it 6 to 12 months in advance, we have time to work on it so that when we do pull your credit again, your credit is better. So I would say that's the biggest issue. And like what we had a client recently, they had really pretty darn good credit, but they had very limited credit. And so their score was a 720, but they didn't have a lot of credit to work with. So there really wasn't more that they could do other than just give it more time. So, but we have that conversation with every client, and most clients walk away feeling much better about their situation.
Good. I never want them to wait till the last minute. Like you said, find the perfect house, and they can't. It's always better to work ahead. Okay, another question I had was, can you put in layman terms, please? The fluctuation in the interest rates, what really drives that?
Oh man, I tell you, it's funny. And I'm sure I'll sort of mention this to you. Like, if you're not playing with AI, we play with Chat GPT a little bit. And so I was playing with Chat GPT to ask that question to see what it would say. And it really gave me some good bullet points to sort of hit them all. But the bottom line is, what determines mortgage rates is the trading of mortgage-backed securities in the bond market. Okay. And what causes the price of those bonds to go up and down is all kinds of news. Over the last several years, it's been all about inflation. Inflation's been the highest it's been in decades, shot up to around 9% due to all the COVID stimulus that took place. And so because inflation went up, you're going to see mortgage rates follow that. Mortgage rates are going to move higher as well. Now inflation is coming down. Mortgage rates are starting to come down. And I think they will continue to improve. And so that's why I think this year we'll see some improvement. Hopefully by the end of the year, we're in the low sixes, maybe even high fives. And then maybe they'll improve a little further next year. But I always tell people if our business is sort of sick, the worse economic news is, the better rates tend to be. So when unemployment goes up, when we enter a recession, that usually means mortgage rates are coming down. And so people who are in a position to buy tend to benefit from the lower rates. People who are looking to refinance also have benefit from that opportunity. Right. But the biggest thing is the trading in the secondary market. It does follow the U.S. Treasury a little bit. So the U.S. Treasury, the 10-year Treasury does, they tend to follow one another, but it's not always the case. There are periods of time where you'll see them trade differently. We might see the U.S. 10-year Treasury yield go up and mortgage rates come down, but that is pretty rare. It doesn't happen very often. Okay. Is that simple enough?
I think so. I think so. We'll always still have questions for you, though.
Well, I will touch on, so the economic conditions I touched on, the inflation I touched on, the central bank. Let's talk about that, the Fed. So I didn't talk a lot about the Fed and what the Fed is going to do. I did mention it at the beginning of our podcast here, where I said that at the end of last year, in December, the expectation, there was 100%, the market had priced in 100% chance of the Fed cutting rates in March, the spring meeting. There was 100% chance. Here we are 3 weeks into January, and that percentage has gone from 100% down to about 60%. Oh. Okay. So it's already shifting, and that's why we're starting to see rates trend back up. Usually, and so people say, oh, I heard the Fed cut rates today. What happened to mortgage rates? Usually by the time they cut, it's already been priced into the market, and it's not uncommon to potentially see rates tick up when they actually do the cut, because they've already priced it all in ahead of time. Then they cut the short-term rate, because that's what the Fed has changed. They're adjusting. They're adjusting short-term rates. For those of you who have savings accounts, you probably have noticed that for the first time in a very, very long time, there are financial institutions paying nice returns on money market accounts. I think Fidelity has like rates between 4% and 5%. And for decades now, they've paid virtually nothing. And so as the Fed lowers those rates, you're going to start to see those money market rates come back down as well. So that's what the Fed is controlling, whereas mortgage rates are more long-term. And so there's not always an automatic impact right away. It's usually a lag effect.
Well, as you know, of all people would know, we got down to under 3% interest rates during the pandemic. I've been told that's never going to happen again if people are waiting for that to happen. If it did, it maybe not in our lifetime. What is your thought on that?
I would tend to agree with it. I do think that, that yes, the old saying, history does repeat itself. I do feel like our government our Fed, Federal Reserve, central banks are learning all the time. I think they're going to review what they did during the pandemic, and I don't think they'll ever repeat that mistake. Yeah. They did a lot of really great things, a lot of things that needed to happen, but they absolutely overdid it. We really probably never should have seen rates in the 2s, maybe not even the 3s, but 3s to a degree based on what we were going through, because at the time I think we were in the 4s, so it wasn't that big of a stretch to get to the 3s, but to go all the way to 2s was pretty crazy. And I think that's the challenge, right? Home buyers are really focused on what they missed out on, as opposed to the reality of what's to be expected moving forward. And most people will tell you, people need to get comfortable with rates in the 5s and 6s. I mean, 5s is going to be good. 5s is going to be really good. 6s is probably going to be sort of normal. And I think we only really see the 4s if we enter sort of a kind of more severe recession, but
which we don't want to see, right?
We don't want to see. And, of course, it's always the events you can't predict, right? Like who could have predicted COVID? No one. Obviously, there's a lot of turmoil in the Middle East right now. And every time I watch the news, it just seems like there's more and more military conflict it just seems to be expanding. And of course, usually when we go into war, we tend to see rates come down, but I don't know. It's sort of a scary situation to watch, but we don't have any control over it. We can't really predict what's going to happen there.
You mentioned the word waiting. So I was at a HIREBA meeting last week, which is Houston Independent Real Estate Brokers Association. And we had a guest speaker who gave us a lot of great information, but I want to read something to you that he passed out because I think this says a lot. In 1971, the interest rate for a mortgage was 7.33%. If you waited for interest rates to go down, you wouldn't have purchased a home until 1993. You would have rented for 22 years, waiting for rates to go down. Meanwhile, the value of real estate quadrupled. Don't wait to buy real estate and wait. Marry the house, date the rate. Because you can always change the rate, right?
Absolutely. I
I
couldn't
thought
say
that
it
was
better
great.
myself.
I thought
Yeah,
that was great. I
it's
really
so
like that.
true. And I try to show people that too. I mean, look, when you're renting, 100% of what you pay is going to somewhere else, right? You're receiving no benefit from it whatsoever. Whereas when you buy a home and you start benefiting from that asset that's appreciated, and like I tell people, so if you're down, let's say your down payment is, $20,000 on whatever you're buying, if that's what you have to put down. Well, you can put it down on a house and buy a house that's say $300,000. Okay. You buy a $300,000 house and that $300,000 asset's appreciating at 3%, 3 to 5% a year, which is kind of historical norm for Houston. You compare that to investing the $20,000 in the stock market that may go up 7 to 10% a year. That $20,000 in 10 years in the market is not going to be anything compared to what your $300,000 asset is appreciating at a much greater, it's a much larger amount. It's a highly leveraged investment. I just don't see many people who buy a home that look up 10 years from now and have regretted it. It tends to work out very, very well.
Right. And you can either put escrow in the landlord's pocket or escrow in your pocket. I choose my pocket.
Absolutely. All day.
Let's talk about down payment now, because that's always a question for people. I know that varies, and there's, you can't put down 3% and expect to get a great interest rate. Do you want to talk a little bit about the different choices people have?
Absolutely. In the space that I'm in, and I work in the single family residential space, 1 to 4 unit properties, we can finance with conventional, FHA, and VA. Technically, we could probably offer a USDA loan, but I've quoted 2 in my career. I'm in the city of Houston, and those products are typically way out in the rural areas, so it's not really my area of expertise. But conventional, FHA, and VA, those are where we focus on. And on conventional, as a first-time buyer, you can put as little as 3% down. FHA is 3.5%. And of course, if you're a veteran or serving in our military, you can put 0 down, which the VA loan is one of my favorite loans to offer. I love working with vets, and the rates are great. The product's great. There's a lot of misinformation about VA loans out there, but it's a phenomenal product. There's so many great benefits to it. It's a great product, and don't be afraid of it if you're not familiar with it. Just make sure you're working with somebody who is familiar with it, and they'll tell you what to be aware of.
Yes, that is so true. You've got the facts, and I appreciate that. Are there any special programs or incentives out there for first-time home buyers? What can we do to get them to take the plunge, so to speak?
Absolutely. With Fannie Mae, so at 3% down, there are other programs like the Fannie Mae Home Ready product, as well as the Fannie Mae Home Possible product. Both are 3% down, and they have extra benefits as far as interest rate and mortgage insurance are concerned. Your income has to be below a certain level to qualify for them. So that's where the income factor comes into play. There are lots of programs out there for first-time home buyers, like down payment assistance and grants and things like that. I just always tell people you really have to be careful with them because there are lots of details with them that you have to qualify for. I've only worked with a couple of them in my career. We're not currently set up to work with any of those programs, but I tell people, certainly explore them, look at them. But just know that your income levels have to be, on the lower end of the range to qualify for them. And so typically what I'm doing is I'm trying to work with clients and work towards the more traditional, 3%, 3.5% down payments. Because if you have good credit, your rates are still going to be pretty darn good. And when you look at the sort of the down payment assistance programs, there are additional costs to them. And there are a lot of them have higher rates, which means you're just paying for it over the life of the loan over a longer period of time. And so if you have a client that's in a position to have it come up with a down payment, whether it be on their own, maybe a gift from family or something like that, they tend to be much more cost effective over the long term.
Well, you brought up another subject, gifts from family. Do you want to talk a minute about that? I know that they're doable, but they come with rules.
Yeah, there are rules around it. They're not terribly complicated, but the number one rule is it's got to be a gift. It can't be a loan. That we get that all the time. It can't be something that's required to be paid back. So So there's a gift letter that both parties sign. We have to document where those funds come from. So for example, I just worked with a client who had more gifts than I've ever seen on a transaction. And it proved to be challenging, but we worked through it. As long as we can document where it came from and that the person has the ability to gift those funds, then we're in great shape. Sometimes I get people that are frustrated by it, but I just have to tell them that the reason we do this is because in the past, we've had clients say, oh yeah, my mom can give me this money. And of course, we dig a little further and mom really didn't have the money. She took out a cash advance on a credit card and then gave her daughter the funds. And that snowball effect isn't really a great situation, right? So we've got to make sure we can source the funds where it came from. Whether it's conventional or FHA will sort of change what the documentation looks like. But again, if you call us, we will tell you the easiest way to handle it. And I have lots of conversations with people providing the gift because sometimes they get frustrated saying it's none of your business. And I said, well, it wouldn't be my business except
Yes,
they're
it is.
borrowing money from me. So therefore it is my business. And
Yeah.
I don't make the Fannie Mae rules. So I'm just following them.
Understood. This is a little bit like after they get the loan, but this came to my mind, especially for first-time home buyers. You're excited, you've got the house, you're almost ready to close, you need a refrigerator, washer, dryer, lawnmower, all these sort of things. And then there's that favorite sofa that you just found that you love. Don't buy any of it. Don't buy it until after you close. You want to talk about that?
Absolutely. Obviously, we get those questions a lot, especially from first-time home buyers because they're the most excited. And it's usually, oh, it's a Labor Day sale, it's a Memorial Day sale. And I said, and guess what? In the week after that, there will be an after Labor Day sale.
Yeah.
And it's like, I just tell them, I say, look, if you have cash to pay for these things and it's not the cash that you're using for your down payment, shop to your heart's content. But it's not worth the potential of it either delaying your closing or worse, eliminating the closing altogether, right? So probably the most common thing that does that is somebody going out and buying a vehicle in the middle of the process. And
Don't change jobs either. Don't change jobs.
And don't change jobs. A number of years ago, I had a client that was repatriating back to the US from overseas. And he said, I need to buy new vehicles. We don't have vehicles. I'm like, okay, well, he had really strong credit. I said, I think you should be fine. I don't really see any issue with your credit. I think your credit can handle it. But I said, but let's make sure your payments don't exceed X. Well, of course, he didn't follow up with me. His payments exceeded X, and then his debt to income ratio became an issue, and he ended up having to pay off a bunch of student loans, and he wasn't real happy about it. I said, well, I was pretty clear in my instructions. So as long as you do what I tell you, we'll be okay. And anyway, but it happens, and some people have to purchase things just because of life. But whoever you're working with lender-wise, I just tell people, talk to your lender, make sure you're communicating about it. Our 10 commandments has that on there. Don't change jobs, don't make big purchases. Some people read that document, some people don't. We do make every client sign it. And people will call us and go, hey, it says not to move any money around. And the purpose of our document is to get people to ask questions. We can overcome a lot of those things as long as we talk about it. But like the one thing, don't move money around. The reason we tell people that is because it creates frustration. Mm-hmm. It doesn't mean that we can't deal with it, because we can. It just creates a lot more work for you, the home buyer, because we have to show the money going from this account to that account, from that account to this account. And so when you have to provide activity printouts, bank statements, et cetera, people get really frustrated with that.
And nobody wants anything that's going to delay the process or delay the closing.
Exactly.
And you mentioned this, but just to clarify, the reason we say don't buy anything substantial is because it affects your debt to income ratio. And that's very important in getting a loan.
Debt to income ratio, as well as potentially your credit, right? So in some instances, it could be, this doesn't happen very often, but every loan that we do, when we get to the end, we reserve the right to do what's called a soft check on the credit, meaning what they're looking for, has any new credit been added? Has any new credit been applied for? And that can A, cause delays. B, in some instances, we do have to pull a whole new credit report. And if your credit score was, say, 781, and that new trade line caused it go to 760 or 759, now all of a sudden your interest rate changes, your pricing changes, things like that. And so again, it just creates more frustration and irritation and possible delays.
Well, Chad, I could go on with you talking about this for a long time, but I think people only have a span of attention so much. So why don't we will get back together again and talk about more aspects of loans and lending. But why don't you give everyone your contact information? What's your website address?
Absolutely. Our website is www.bwclending.com. BWC short for Because We Care. So bwclending.com. All of our contact information is there. Feel free to reach out, email me, call me, whatever works best for you, and we'll be happy to help you.
And people, they really do care. All right.
You
Thank
sure
you
do.
so much, Chad. I'll see you soon.
Thanks so much, Gene. I appreciate it.
Thanks for tuning in to The Real in Real Estate, your gateway to the source. Be sure not to miss our upcoming episodes loaded with fantastic insights, expert tips, and all the latest trends in the property scene. Don't forget to stay connected with us on our Trilogy Realty Group's socials: Facebook, Instagram, YouTube, and even TikTok. Until next time, take care.